Stanford University.
So today's session is all you need to know about venture capital. So we're going to do a really quick run through on pretty much every single topic that's relevant to VC, from anywhere from sourcing deals to how to get into VC, how a VC firm is structured. So quick table of contents. So we're going to be going over a couple of these topics right here. So it includes getting into VC, dynamics of negotiating a finance round, sourcing deals, term sheet basics, and our emphasis for certain topics is just based on the poll that we sent out. So we're going to emphasize certain topics more than others. Definitely interrupt anytime. This session is to be very helpful to you. So if you have any questions, feel free to interrupt us at any time. So I guess next slide. So getting into VC and staying in VC. So there's kind of two options to get into VC. One is as a partner, two is as an analyst or associate. Getting in as a partner, there's no application, there's no job application for VC. It's all based on connections. So the typical track for getting straight into VC as a partner involves either one, you've founded a very successful company, or two, you've worked at a portfolio company as a high-ranking executive, one of the billion-dollar unicorns at the company, and you've been invited to join as a partner. It's all based on connections, so typically it's the VC firm has already funded your company, and now you've made it big and you're looking for a second career, so you're joining into VC. The second option is if you're an analyst or associate. This is typically out of pre-business school or out of business school straight out. So sometimes there might be a blog post, a job posting, or you have 1 to 4 years of management experience, or you've joined a trendy, fast-growing startup and you're in a ED role and you're hired as an analyst or an associate. Okay, so the way to stay in VC is ABC, always be closing. So every single VC fund has multiple funds. In order to stay with the fund, you have to be successfully closing deals, making money for the fund. Otherwise, you'll be booted from the next fund. So always be closing. So dynamics of negotiating a financing round. A lot of you had questions around this. Dynamics of negotiating a fundraising round, it's pretty complicated in terms of, I consider an intricate balance between one, convincing the founders, and then two, convincing the rest of your partnership to fund the deal. So on the founder side, the very first thing you do when you meet an entrepreneur is assume it's a really, really good company. Reason for that is if you show any waiver of like dislike or distaste for the company, that's going to hurt you later on, because you never know if this founder and this company is going to start the next billion-dollar company. Their first idea might be terrible, the second idea might be wonderful. So as a result, working with the founders, the very first thing, keep an open mind, be really friendly and positive to the founder, in addition to pitch your partnership and pitch your firm. The biggest thing that's most important for the founder is that you need to start building your reputation before you're actually even starting negotiations. So that involves one, sitting on panels, judging demo days, judging events, and really building a media presence and a reputation in the Valley before you actually even meet the founder. And then the second thing is, once you actually meet the founder, you want to constantly be able to pitch your partnership, leverage all of your partners, their experiences, their accomplishments, their successful deals, and be positive in pitching them, because every single deal, which we'll talk about later, is a competitive deal. So you're going to have at least 2 or 3 term sheets and 2 or 3 other VCs that you're competing with. So meanwhile, you're always thinking positively. This could be the next billion-dollar company when you're talking to founders. On the other hand, you also need to convince your partnership. So typically, when you're working with a partnership at a VC firm, every partner does maybe max 2 or 3 deals per year. And this is like serious kind of like board, when I say 2 or 3 deals, significant board seat deals. Typically you get 20% ownership in the company. You're spending a lot of time with the founders as opposed to just a small angel investment. So pitching the partnership, you're probably seeing like hundreds of deals every year. There might be maybe like 8 or 10 deals that you might fund, and then at the end of the year, you typically fund 2 or 3 deals. So every single time you see a really awesome company that might be one of those 8 or 10 potential deals, you need to immediately go to your partnership, start pitching it, start getting feedback from all the partners, just because a VC firm is a partnership. You're not the only one making the decision. You need to be constantly getting feedback, identifying issues early on, just because at the end of the day, it's generally a consensus vote when it comes to whether or not a company is going to be financed. So just quickly in terms of process-wise, as a VC, you're always constantly looking for deals, sourcing deals. Once you find a company that's one of those 8 to 10 companies in which you think you might want to invest in, there's the balance between convincing the founder and then convincing the VC. Once you have a general understanding that a deal is probably going to happen, the next step is negotiation around the specific terms. We'll go over a couple specific term sheet terms that are very important. Once that process happens, there's the term sheet is signed. There's an in-depth due diligence phase, which typically includes tech diligence. There might be an outside consultant who helps with that. Financial diligence, if it's a later stage company. Also, sometimes background checks. VCs might do background checks and reference checks as well. So. Once that's due diligence is completed, there's the final doc stage. So these are all the lengthy legal docs that actually happen. The term sheet is typically only 1 to 2 pages, while the legal docs are probably around like 10 plus pages. And then final step is the money's wired. So a deal isn't closed until the money is wired, and it could fall apart at any minute. Competitive rounds. So every single good deal in the Valley is a competitive round, and you should assume that every single company you meet is going to be competitive. You're going to have at least 2 to 3 other term sheets on the table, two or three other VCs who you're competing with to try to get that 20% ownership, to try to get that board seat and be involved with the company. So you need to treat every company and every round that you encounter as a competitive round. There's kind of 2 strategies for doing that. The first one is the more aggressive and move fast. So this is where you meet a founder. They haven't kicked off their fundraising yet, but you know that they're about to do so maybe in a couple weeks. You think that it's like the next Facebook, the next Google, and you move very quickly, throw down a term sheet, and even the strategy for that is partners have partner meetings on Monday, so you might throw down the term sheet on Saturday just because the founder can't line up another term sheet within a week, and then the term sheet will be considered maybe like an exploding term sheet that expires within a week, and you try to win the deal that way. That only happens and works probably 1/3 of the time, just because all great founders typically have advisors surrounding them, people who are mentoring them and have connections in the Valley, and the Valley is working against you in this case. So with an exploding term sheet, you have advisors to the founders who will likely introduce them to other VCs and try to get the round done within that 1 week time period. So that works maybe 1/3 of the time. The better strategy is being the last one to put down the term sheet. And this only works if you know, if you have the connections and know intimately what the dynamics of the fundraising round are going to be. You know who else is putting in term sheets at approximately what valuation, you're close friends with some of the advisors to the founder and to the company, and you're the last one to put down the term sheet, and you end up probably putting it at a slightly higher valuation. You've already built a relationship with the founders and the advisors, and you end up winning the deal that way. It's a dangerous strategy. If you execute it well, it works well, but if you put down the term sheet too late, then you just completely miss out on the deal. So
how much of the specifics on the term sheet are actually negotiated versus just I'm going to do a deal or not do a deal, and are you doing those negotiations as VC, or is the board just doing some of those specifics?
So early on, the most important thing is how much money is being put in, what's the valuation for that. Typically, every single VC firm is trying to, when you think about a Series A or Series B round, VC firms are trying to get around 20% of the company. So we'll dive into valuation in a second. So as a result, like, the most early on, it's all about how much money is being put in and what's the valuation, and then from there, there's a couple other provisions that are negotiated, but those are pretty standard. So, yeah. Yes.
And can you speak a little bit more about like some of the term sheet standards, like dividends or like things of that nature?
Yep, that's the next topic. So just to quickly wrap up on this topic around co-investors. So co-investors happen, angel investors, other investors happen in pretty much every single financing round. There might be someone, a co-investor who you absolutely have worked with in the past and absolutely don't want to be a co-investor in the round. Key strategy for that is don't argue with the founder early on that, just because that's going to hurt your ability to win the deal and negotiate, get the round done. But that can always, co-investors, that can always happen and be negotiated later on. Another thing to keep in mind is the co-investors typically take up only like 1 to 2% of the entire financing round, so it doesn't make a huge difference. As a VC, you want to optimize your ownership. You want to get as much as the round as possible if you actually decide to commit to the company and you actually want to invest in the company. Every single VC wants to get as much of the round as possible. So the final thing to keep in mind is actually for co-investors is it's a reciprocity ring around Silicon Valley. So if you help someone get into a round of a hot company now, it's going to come back to you later and they'll let you into another financing round. So. This is just because keep in mind that every single good deal is competitive and there's more dollars that want to be put into the company than there's space for. Yeah.
Perhaps this is what you're talking about with co-investors, but how often do you see like strategic investors that aren't funds? Let's say I'm going to sell into commercial buildings and there's like a massive construction company that wants to get in and that could give the entrepreneur access to like a key contract. Is that frequently part of any given round, or is that an exception?
So strategic investors are definitely kind of a whole another ballpark. So there's been a couple, I guess I'm negotiating a financing round right now actually with 2 to 3 strategic investors. There's a couple different, as a VC, a couple different investment strategies on that. One of the main currencies of VC is being able to take a board seat, and most founders don't want strategic investors, say if you have like a Google Ventures, like a Rakuten in Japan, or basically a strategic investor sitting on their board just because of information rights, and if you work with, say like Rakuten's on your board, then likely you can't get like another e-commerce company on your board as well. So strategic investors, for most of those rounds, I've seen VCs put in a smaller amount of capital, but still be able to take the board seat. And you have a couple strategic investors filling up that round. Yep.
Just one question. What's the competition? Talk about the competition, but theoretically, if I have a good company, I would go first with the top tier VC, right? So I don't know, take the bears, probably in their table you have the deals coming first. Is this a reality or no? Because you should have a segmentation. How this works?
Yeah. So as a founder, when you're looking for a VC to partner with, it's really a long-term relationship and a long-term marriage in many sense. You're going to be stuck with this VC for years and years and years, as long as your company's around. So it's actually, the best entrepreneurs actually don't look at the top tier brand name VC that they want to partner with, but actually who's actually working with them on the deal, who's actually sitting on the board. So you might get a term sheet from, say, like NEA, Sequoia. NEA only has a couple partners. They have a number of principals, a number of associates, a number of analysts. If you get a term sheet from NEA, you might not actually have the partner sitting on the board, but you might have instead like an associate or a principal sitting on your board. So it's really in terms of like the best entrepreneurs look for the best partner and the best person who's sitting on their board and working with them long term. So.
In a financing round, what percentage typically are like invested by the lead investor versus the co-investors?
Financing round in general takes up about 20% of the company. A VC, the lead investor typically takes up almost all of that 20%, and there's I guess like a couple angel investors who will co-invest. That's typically the structure. Yeah.
Earlier we were talking about like shopping around term sheets, but I've heard about like no-shop clauses, so I was kind of confused about how that fits in.
So the no-shop clause is in the term sheet. That happens at the very, very end. Keep in mind that there's a lot of conversations that happen early on in terms of like, is there general interest from this VC in funding your company? And those kind of conversations are before a term sheet's even thrown down. So when a term sheet's actually issued, there's a pretty good sense of whether or not there's a strong partnership and potential funding that will happen. We'll talk about the term sheet, kind of some of the terms of that. So sourcing deals and finding investment opportunities. We'll run through this super quickly as well. So there's a couple ways you can source and find deals. There's one of one more the data-driven approach. So you're constantly tracking who's rising in the App Store rankings, who's rising in maybe like the Alexa ratings for top sites. or you're attending demo days at incubators and accelerators, or you're targeting universities and trying to hunt down some of those research teams. The most important thing to keep in mind for that is anything that's available on the internet or is present at a demo day, you're not the only one looking at it. There's hundreds and dozens of other VCs looking at that. So the most important thing for sourcing is really make sure that you have your network in place. So even for example, like for demo days, you might be going to a YC demo day, but some of the best investors actually know all the companies that are presenting before they even present. And that's because they've had founders in their portfolio who've already gone through YC, are providing them advice on some of the hot startups and companies that are happening. So main thing to keep in mind for finding investment opportunities is that if it's an official event, data that's available on the internet, likely someone else already knows about it. So quickly, in terms of what do VCs look for investments, it's three things. Everyone's going to tell you the same thing in some sort of variation if you ask a VC, and that's 1, tech, 2, team, and 3, product market fit. So 1, is there like strong technology? Is there a strong product behind this company? 2, team, like what have the founders done in the past? Is there evidence that they have a vision that they will be successful in what they're doing? Just because an idea is cheap, it's really about how you execute it, and that's what the team's there for. And then 3, is there a product market fit? Is this actually a need that's being met? You don't want to take over like 100% of a $10 million market, but instead if you take like 1% of a $1 billion market, that's a lot better. Let's see, so I guess how relevant is it to have a detailed investment thesis? So that's a challenging question, which I'll get back to a little bit later when we talk about GP-LP dynamics, but you want to make sure that you have a general sense of what market you want to target and when you're developing that investment thesis, but also make sure that it's flexible enough to include a number of different investments. So you don't want to be, for example, if you're looking at investing in big data, AI, you don't want to just be targeting one specific segment like personalization, just because the number of companies that are going to come out of personalization every year might be maybe like 10. And if you can't invest in any of those companies because 1, they're really bad, or 2, it's a competitive round, that basically destroys your entire sense of an investment thesis. Let's see. And I guess kind of final aspect of one of the questions that someone emailed in is, what is the term smart money? So this is just the idea that every single dollar you're providing as a VC, it's not just the capital, but more importantly, it's the people, the relationships, the connections, the advice that you can provide that really helps the entrepreneur. Yes?
So given that like 99% of deals are turned away, can you talk about internal organization and how you keep track of companies that you've turned away? Do you network with them and keep up with them? Do you shoot an email once a year or something like that? How do you remember to do that?
So different VC firms definitely take different approaches. I think the one firm who takes probably the most structured approach to it, and this has only been like a recent phenomenon in the past maybe like 4 years or so, would be the agency model. So companies like firms like Andreessen Horowitz, in which they track every single time they reach out to a founder, how often they interact with a founder, whether or not they fund them or not, and the advice that they provide. So Andreessen Horowitz, if they don't fund you, they might still invite you to some of their dinners or sessions, and they try to stay on top of interaction with founders. The other extreme is actually what I see most VC firms doing, which is a pretty informal method of keeping track in terms of literally like I've seen firms in which you just manage it through your inbox. So a deal surfaces back up and you do a quick search in your inbox to see if you've interacted with the founder in the past. And if you have, then you'll kind of observe what that interaction was like and then build off that. And if you haven't, then you consider it just a fresh meeting. So keep in mind that like most VCs probably spend most of their time looking for deals, but also maintaining their portfolio, which we'll talk about in a second. So I guess keeping track of founders who VCs have turned down isn't kind of a high priority or even considered a lot. So quick note on term sheet basics. So we'll quickly run through some of the most important terms in a term sheet. So keep in mind that when you're in a VC negotiating a term sheet, the 2 most important things you want to keep in mind are economics and control. So running through some of these terms, pre and post money valuation. This is pretty simple addition. You've started a company, you think the assets are currently worth maybe $3 million. A VC comes in, puts in $1 million. Now it's worth 3 plus 1, $4 million. So the pre-money valuation is $3 million and the post-money valuation is $4 million. But keep in mind that it's actually, even though it's 3 plus 1 equals 4, the $1 million is likely adding a lot more value than just $1 million, which is why someone would even give up ownership of their company to take that $1 million. So I guess another term, liquidation preference. Liquidation preference is the main thing that distinguishes preferred stock from common stock. One company that's actually pretty interesting example, which actually absolutely hates liquidation preference, is Snapchat, in terms of they have investors investing at the common stock. So it's a pretty unique case, but typically liquidation preference is always present. So the main aspect of liquidation preference is that VCs get their money back first. So it only really matters when a company sells below their valuation price. So basically, if a company's worth, say, the valuation is $10 million and it sells for $5 million, basically whatever amount of money that a VC has put in for 1x liquidation preference, they get that amount back first. There's two types of liquidation preference, participating and non-participating. Participating doesn't typically happen. It's a pretty aggressive term for a VC to negotiate that. That basically means that the VC gets back not only their money, but also their percentage ownership. Non-participating, basically the VC just gets back the cash that they put in first. Board of directors, typically if a VC is putting in a significant amount of capital, they want to take a board seat. Generally, it initially starts with your first institutional financing round would be a 3-person board, which consists of one of the founders, the main investor, the lead investor, as well as an independent seat. Oftentimes, the independent seat might not be filled immediately, just because the meetings and the board meetings that happen are pretty friendly, pretty collegial. Once it gets to a larger round, another institutional investor comes in. That typically expands to a 5-person board. 2 folks from the founder side, the company side, 2 VC investors, and a 5th independent board seat. Basic role of the board of directors is just to help guide the CEO and hold them accountable. Board of directors have fiduciary responsibility, so they need to do what's best for the company. Let's see, protective provisions. These are basically, depending on the relationship you have with your VC, this might change. So this can include from if the company spends a certain amount of capital, then they have to have board approval before that's spent. So protective provisions just protect the VC. Right of first refusal. So this is a generic term that's sprinkled throughout the term sheet. It typically is around the sale of secondary shares. So the idea is that basically, you have, as an investor, if a company, for example, is selling secondary shares, you'll be able to purchase those shares before it gets out to other individuals outside the company. Sometimes there's a right of first right of first refusal chain. So, for example, in the sale of secondary shares, you might have first a right of first refusal with investors, and then the founders. And then people outside, the angel investors and the people outside the company, and then that chain just continues onward. So pro rata, this is a term that just means in proportion. So the idea is that you invest in the Series A as an investor, you own about 20% of the company. In the Series B, when there's new money coming in, you're going to get diluted, but you have the option to actually put in additional capital at the Series B valuation to maintain your ownership of 20%. Keep in mind that this is kind of a one-way term, so basically only the investor has the right to say whether or not they want to maintain that 20%, and that typically happens if it's a good company. Otherwise, if they decide to let go of their pro rata, they'll be diluted in the future financing round, so instead of 20%, they might own 17%. Let's see, next terms. So drag along. Drag along basically means that as an investor, a lead investor, you're making a lot of the decisions for the company, and there might still be, say you might have like 50 angel investors in your cap table in your financing round, and when you're making significant decisions at the company, you don't want to go to every single 51 of them to get their approval. Drag along just basically means that the lead investor is dragging along the angel investors, typically the other minority investors. So employee option pool is, there's kind of 2 general thoughts on that. One is like it's a simple way for employees to get upside in the company and actually get some ownership. And there's the story of the Facebook cook who became a millionaire because he got some employee option pools. The other aspect of it that most people don't realize is the economic aspect. So there's kind of two different ways you can look at it. One, as an investor, you can actually have the employee option pool created, typically around 15 to 20% created before you finance the company. What that means is that you're actually diluting the founders with the employee option pool created before, but you're not diluting yourself as an investor. What the best entrepreneurs prefer is actually that the employee option pool is created after the financing round. So what that means is that when the 15-20% employee option pool is created, you're diluting both the founders and the investors, not just the founders. And finally, no shop agreement. So keep in mind that term sheets aren't binding. So as an investor, you can actually sign a term sheet and not follow through on the financing round. This typically doesn't happen just because your reputation is on the line. And as we know, Silicon Valley is really small. If you sign a term sheet and you end up not funding the company, that's going to hurt you later on as other entrepreneurs talk about that. The reason the no shop agreement exists is because VCs, as general partners, are accountable to their LPs who are providing capital. So after the term sheet is signed, there's an in-depth due diligence phase just to make sure that the tech, the product, the team is really who they say they are. And the no-shop agreement is generally around 40 days. Investors want to, there's kind of this balance between investors want to make that longer, around 60 or 90 days, and then entrepreneurs want to make that shorter, maybe around 30 days. But the idea of the no-shop agreement is that you're not going to be shopping around the term sheet and the valuation. Otherwise, it's just a never-ending cycle. Portfolio management. So any questions on term sheets? Yes.
For the drag along, is that when you're, as a lead investor, that you make decisions for whatever your angel investors who are behind you in terms of financing decisions or in terms of the company or decisions that impact the company you've already invested in?
Pretty much all major decisions ranging from like the sale of the company, like firing of the CEO, major business decisions. So, yes.
When David Hornick was talking about during pitches, like that basically entrepreneurs, typically financial pitches are just wrong. Was he talking about like the pre-investment valuation of the company, and how are those kinds of finances worked out in between the two entrepreneurs?
So just to clarify what David Hornick was saying, the valuation that the entrepreneur wants versus reality, is that?
I think so.
Okay. I guess keep in mind that like in a financing round, like an entrepreneur probably wants like $100 million, like really high valuation. As a VC, like your entire partnership maybe wants like 2 million. So there's like a huge disparity. And I think what David was probably referring to is you have this negotiation between, you need to bridge together both the founders and your partnership to reach somewhere in the middle.
Okay.
I can add to that.
Yeah.
So what David was saying was basically when you're doing your deck and you're presenting your financials and how you're going to, project your sales, that's all BS usually, right? It's like, how can you project 5 years from a market that doesn't exist? Mm-hmm. But he wants to see, what he wanted to see was how you're thinking about it, right? What are your costs? Who are your customers? And that type of stuff. It's kind of separate from the valuation of your company. Mm-hmm. Somewhat related in the sense that if you can make 100 million sales, then you can get a bigger valuation. But he was saying, have a slide, if you're going to pitch a VC, have a slide of your sales or how you're going to make money, but just know that everyone knows it's BS, right?
Yeah. Yes.
Actually, before I met Ernestine, I would often get students like you say, can you get me together for breakfast with a VC? And I said, yes, we can do that, but you have to have a spreadsheet that shows cash in and cash out. And oftentimes people would say, this is the point, I'm so brilliant, I don't need to do that. They would show up, the VC would come, and the VC would say, this meeting is over. And the argument was, just Linus's argument, if you can't make up numbers that make it look like you could be successful, why should they believe anything else you say?
That's funny. Cool. Okay, so portfolio management. As a VC, you probably see in your portfolio 3 different types of companies. 1, unicorns. 2, I call them dragon eggs. It's kind of a new term that hasn't been used widely. And then 3, the Walking Dead. So unicorns or decacorns are even better, are basically your $1 billion outcomes They're the ones who are basically your really successful companies. Dragon eggs, these are the ones who have the potential to probably make your fund, probably become those billion-dollar outcomes, return your fund multiple times over. And then Walking Dead, these are the companies who are basically just consistently operating, but probably not going to create a huge exit for you. So every single VC wants to work with the very, very best companies in their portfolio. That's naturally where VCs want to spend their time. You have 10 companies you want to work with, say like the top 3 or 4 consistently. And that's just the case from, say for example, you have like the next Facebook, the next Google, like Snapchat blowing up. You want to be the one supporting that entrepreneur and like building that relationship as the entrepreneur goes on to become a billionaire, because he might maybe angel invest in some of your future portfolio companies. And you typically don't spend as much time with the Walking Dead companies. I think the strategy in which VCs spend time with Walking Dead companies varies and is really interesting, just to keep in mind, because a company that currently looks like a Walking Dead company might actually create a spin-off product and become the next billion-dollar company. So Walking Dead strategies. One I've seen is kind of like the activist and the harsh model. So this is where the VC is super active, maybe firing the CEO, replacing the management, significantly shifting the business idea. One clear example of that was actually PayPal, in which Sequoia had 2 portfolio companies. One was led by Peter Thiel, another one was led by Elon Musk. This was like right after the height of the dot-com bubble. A lot of companies were Walking Dead companies at that time. Sequoia decided to actively merge the 2 companies together and create PayPal, which was a fantastic outcome for them. The other strategy on the other extreme end would be being an activist and supportive person, supportive VC. So this would be the case in which Charles River Ventures, they had a company called Odeo, which was basically a Walking Dead company, wasn't really showing kind of that billion-dollar unicorn outcome. That company actually ended up creating a spin-off product called Twitter, which they funded and became a billion-dollar company. So you can take an activist and a supportive role in that sense. And then the third strategy, if you have a Walking Dead company, is just completely ignore it and don't support it. We actually don't even hear stories of this, because the thing is, if it's a Walking Dead company and you're completely ignoring it and not supporting it, and it goes under, like no VC talks about their failed companies. If it's a Walking Dead company and you ignore it and don't support it, and the founder manages to make it a success, you're typically a VC just like jumps in and starts helping it immediately and becomes very active in it. So we don't typically hear of the ignore and don't support companies.
Is the metric today towards looking for the unicorn companies just a Silicon Valley phenomenon, or is it for all VC if they're in the East Coast, Midwest? Or is it just focused on the tech companies versus tech-enabled or consumer companies? Because it seems like that's a very high bar if that's your only criteria for an investment.
I think as a VC, the most important thing is making sure that you have companies that are going to return your fund. So say if you have like a $50 million fund, you want to create a huge outcome that you can actually generate the $50 million back plus more capital. So it's as opposed to like if you invest very, very late stage in a unicorn company and you only have maybe like 2% ownership in the company when it sells, you actually can't make your fund back. So I think the number one priority for a VC is you're looking at your portfolio. What are the companies that are actually going to return your fund and make a return?
It's a little bit of a sourcing question, but where do you guys go to spot an emerging trend, for example? Like, do you look at YC class? Do you look at what the brightest Stanford undergrads are majoring in, what they say they're excited about? Why does, at one point, everyone want to talk about machine learning and AI, and another point, people are into legal software suddenly? Like, where do these trends emerge from, and how do you look to spot them early?
Yeah, I think that's really interesting, because I think the one region which probably has kind of the most extreme example of VCs just pouring money into like one sector and then another sector and then another sector is actually China and Asia. So if you actually look at China in terms of like where dollars have gone, initially it was like all this money pouring into like social, and then all this money pouring into O2O, kind of like sharing economy, Uber, Airbnb, DoorDash kind of companies, and then now there's like all this money pouring into VR, AR. I think the Valley has actually been a little bit more kind of general in that, in terms of VCs are constantly investing in multiple different sectors. So I guess for me personally, I have, I guess kind of like, I guess you can call it like spies or people in like different parts of campus and like different parts in the Valley. So basically you having like close connections and close friends who are actually involved in different communities and tracking the hot investments there.
I just add to that. I mean, I think in terms of trends, it's also pretty easy because we look for tech breakthroughs, right? So what is enabling a certain trend, right? So like big trend used to study machine learning, right? It's the cost of computing, right? Algorithms have evolved, right? So there's sort of like market forces that create these trends, and it's pretty easy to spot. So it's really that type of stuff, and then people are just constantly reading this. And then to your other question about what sort of VCs are using to kind of spot companies or figure out what are the next hot things. I think there are a lot of data-driven VCs now, like using metrics and trying to scour LinkedIn for people who are moving jobs or trying to profile entrepreneurs that generally have a good track record. So there's a lot of data science now being applied to even the VC industry, right? And some of it's enabled through sort of like the cost of computing becoming cheap. So it's really interesting on how it's going.
Yeah. Okay, so we'll run through this super quickly. So in terms of VC firm composition, governance, and dynamics, we'll go through this pretty quickly. Basically, every single VC firm has, I would consider, 4 roles between everyone who's working there. The first one is analysis and market research. The second one is sourcing. Third one is investments and portfolio management. And the fourth one is fundraising. The specific role, whether you're an analyst, an associate, a principal, a general partner, a partner, varies between those 4. It actually probably tends more towards the more senior you are, the more you're involved with sourcing, investment, fundraising of the fund. How are investment decisions made? So every single VC in the Valley, if you try to schedule a meeting between 9 a.m. to maybe like 1 p.m. on Monday, is probably booked, just because typically VC partner meetings are on Monday. The way investment decisions are made vary from, some firms might have a formal investment committee in which they'll have a majority voting process, maybe like 3 out of the 5 partners must agree on the deal. Some VC firms are a little bit more casual in terms of, as long as there's general consensus on a deal and no significant objection or concerns, then the investment is going to go through. And then some firms, typically in like corporate VC funds, there's just one person making that decision. That's kind of general voting. In terms of another thing to probably keep in mind is also for decision making is the life cycle of the fund, in terms of when you've raised a $100 million fund, typically early on you're making a lot of investments that follow the investment thesis very, very strictly, the investment thesis that you've pitched to your LPs. If you're near the end of the fund, you're very, very careful about what are the final investments you're going to make out of that fund, because it's going to affect how you fundraise for your next fund. And then in the middle of the life cycle of a VC fund is typically when a lot of the crazy investments are made, generally speaking. So I guess we'll quickly run through GP LP dynamics. Let's see. Okay, so role of LPs. LPs, limited partners, they invest in VC funds. This can range anywhere from like high net worth individuals to corporations, to hedge funds, to, or not hedge funds, to like institutional investors, as well as universities like Stanford. Let's see, critical components of a good pitch for LPs, especially in the first fund. The first and most important thing is the team cohesion and synergy amongst the GPs. So are the GPs actually able to work together? Every single VC firm is a partnership. Are they able to work together and make good investment decisions together? Do they have a lot of synergy and good flow amongst them? The second aspect is the market thesis, or their investment strategy. So are they targeting like a specific sector? What is their investment strategy? Are they maybe like targeting college campuses in their research? How is that investment strategy different from other VC firms? And then the third aspect is this team actually, the general partnership, well suited to actually source and close investments based on the investment strategy? I guess I'll probably just wrap up on, I think there were a lot of questions and interest around, or jumping back to that slide, around the typical structure of an LP agreement between GPs and LPs. That typically is around 2 to 3% management fees. So what that means is that you have a $100 million fund. As a GP, you're given $2 to $3 million to basically manage that fund. Typically another structure is 20% carried interest. So that's just a 80-20 split of profits. So say you have a $1 billion fund, you make $2 billion out of the profits. The LPs got 800 million, GPs got 200 million. And I would say the most important thing when raising a VC fund is, one, making sure that you have control over the IC voting rights. I've probably been approached by half a dozen LPs to start a VC fund, but where that one of the LPs is actually sitting on the investment committee and helping make investment decisions, which is hugely difficult if you're trying to operate the fund and make a return. And the second aspect is sometimes you'll see LPs who want to swoop in and take GP carried interest, and there's a lot of misalignment if you try to do that. So I guess we're running short on time, so we can answer additional questions and stay a little bit after if you have specific questions around that. So.
Thanks.